The U.S. economy grew by 2.5% in the first 3 months of this year, but that was less than the robust 3% most experts were predicting. Much of the gains in the gross domestic product came from strong consumer spending, but businesses and the government spent less, raising concerns that growth may grind to a halt in the months ahead unless some big changes are made. American consumers get most of the credit for revving up the economy. They were buying cars, lots of them, and houses, and paying utilities to heat those homes. Consumer spending rose at a 3.2% pace, the fastest in 2 years. So why was that GDP number such a bummer? Consumers funded many of their purchases by saving less. That trade-off pulled the nation's savings rate down to 2.6%, the lowest since 2007. Higher payroll taxes in March also didn't help. Paychecks got skimpier because of that 2% tax hike. Government spending cuts, the so-called sequester that went into effect on March 1st, were another biggie. Deep cuts in defense purchases were a big drag on economic growth, and so were the furloughs and layoffs. With new job worries back into the mix for hundreds of thousands of government employees, people turned cautious about spending. American businesses also pulled back, spending less on equipment and software and holding off from hiring. On the trade front, U.S. exports rose, but we imported more, and that sliced off growth. And American companies can't look to Europe for customers, as the recession there continues with little hope of improving anytime soon. There are now new concerns about the U.S. economy creeping along for the rest of this year, and more sequester cuts are on their way. Many government agencies are just beginning to furlough employees and cut back on spending.
Here now to discuss his economic outlook is Brian Wesbury. He's chief economist of First Trust Advisors. Brian, welcome. Good to have you with us. Okay, so
Tyler,
2.5%. Great to have you. 2.5% in the first quarter. What do you see for the rest of the year? Are we going to kind of muddle along at this rate, or maybe a little better, maybe a little worse?
Yeah, well, Tyler, for the last couple of years, we've been describing the economy as the plow horse economy, not a race horse, not a thoroughbred. It ain't going to win the Kentucky Derby, but it isn't going to fall over and die either. And what we've been seeing is about 2% growth in this recovery. We actually expect this year, 2013, to accelerate a little bit from last year. We're looking for growth in the 2.5% to 3% range. So today's growth was on the lower side of that, or the growth in the first quarter. Housing's now coming back. Autos have fully recovered from the crisis. Banks are lending again. Consumer spending is at a record high. Business investment is up. And so, in fact, the private economy is growing, even though the government is shrinking. And by the way, I think that's a good mix.
Brian, I noticed today that the bond yields on the 10-year were down about 1.6, 1.65. That would, all other things being equal, suggest a slowing economy.
Yeah, sure. Well, if you listen to bonds, we should have never had a recovery. If you look at stocks, you know that we've actually been growing, and corporate profits are at an all-time record high. You know, I think you can spin this data and make yourself feel really bad and talk about how government is a drag on growth. But in fact, if you take our GDP report today and take away the government spending declined. If you back away and just look at private sector growth, it was up 4% in the first quarter at an annualized rate. That's a boom. That's the kind of growth that we had in the 80s and 90s. Housing was up at double-digit pace. Consumer spending, as Susie said in her report, did very well. Business investment was up. When you look at those kinds of things, those are the real drivers of private sector growth. And I think we've scared ourselves into looking at every number from the glass half empty point of view. And I would rather see us think about it as the glass half full. In fact, in the past 4 years, when the economy has grown just 2%, plow horse type growth, the stock market is up 150%. So investors who would have believed in America would have more than doubled their money. And I think being fearful of the economy and what's going to happen in the future is costing people a lot these days.
2.5% growth with very little inflation is not necessarily a bad formula at all. You make the point, don't you, that the sequester actually may turn out to be, number one, less damaging to the economy than the hand-wringers would suggest, but also in a funny way, a good thing. Explain that.
Yeah, sure. One of the key things to remember about government spending is that every dime the government spends, every dime has to come from the private sector. They either tax it from the private sector or borrow it from the private sector. So when the government grows as a share of our economy, that means the private sector is a smaller share. And therefore, there are fewer jobs created, fewer new inventions come along. And so when government shrinks as a share of GDP, which is the key point, we're not actually cutting spending, it's just growing slower than GDP today. What that means is the private sector grows faster, and we saw that today. Overall GDP was 2.5%, government was down, but the private sector grew 4%. So that's what we want to see. We want to see faster growth in the private sector, and as a result, I think the sequester in reality will help the economy grow at a more sustainable and a faster growth than just the plow horse growth if we continue to keep it in place.
Ryan Wesbury, Chief Economist of First Trust Advisors, thanks for being with us. Have a great weekend.
Thank you, Tyler.